Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day. After 2 years of deliberations, a parliamentary panel tasked with reviewing India's first personal data protection bill submitted its recommendations last Thursday. The committee suggested wider exemptions to the government from the bill's provisions, which has raised concerns from opposition. It has also not addressed issues raised by the industry over data localization rules. Let us see what implication the bill may have in its current form on privacy rights of the citizens.
The 30-member Joint Parliamentary Committee on the Personal Data Protection Bill 2019, headed by BJP MP PP Chowdhury, presented its much-awaited report recommending several changes to the draft bill. Some of the key proposed changes to the bill include having a single data protection authority for personal and non-personal data and provisions for localization and cross-border flows of data. MPs including Manish Tiwari, Mahua Moitra, Jairam Ramesh and Derek O'Brien gave dissent notes to the committee. Congress MP Manish Tiwari rejected the bill in its entirety, citing an inherent design flaw. This is what he has to say.
The bill, as it stands constituted, splits the entire digital universe into two halves. While the bill will apply in all its force and rigor to the private sector, for the government space, there are exemptions and breakout clauses and escape hatches which have been built into the design of the bill. In my limited understanding, as a lawyer who's been practicing for over 3 decades now, a fundamental right is principally enforceable against the state. And if there is a legislation which actually exempts the state in its entirety from the rigors of the data protection regime, I wonder as to how it will ever stand the test of constitutionality. Clause 35, Clause 11 of the bill are extremely problematic. Coupled with that, the entire penalty and compensation regime is very onerous, and it will kill the startup sector in this country in its entirety.
The contentious Clause 35, highlighted by Tiwari, gives wide-ranging powers to the government to exempt any of its agencies from the purview of the Data Protection Bill for purposes of security of the state, friendly relation with foreign states, and public order. While the bill seeks to promote a free and fair digital economy, it increases the compliance burden on startups with its burdensome rules on data storage and transfer. The committee's chairperson PP Chowdhury has said his panel suggested enough safeguards to protect individual privacy, but it cannot override national security. We spoke with Apar Gupta, Executive Director of Internet Freedom Foundation, who provided elaboration on the exemptions given to the government and also threw some light on the stringent data localization proposals.
What is very noticeable in the JPC's recommendation is the security interest of the state, which has been made paramount. So, for instance, it provides for the non-consensual gathering of data by government departments under Clause 12, which has been retained. And if you look at Clause 35, it provides the government a very wide ambit of power to exempt government departments completely from the application of any of the safeguards, protection, remedies which come under the Data Protection Act. And one important part more which solidifies its power are the powers of the regulatory body, which is called a Data Protection Authority. Now, this authority, in exercise of several of its functions, has to act in consultation with the central government. Its members are appointed by the central government, and also there are certain clauses by which the central government can make policies which will be overriding the protections under the Data Protection Act. So this puts a large question mark on whether the Data Protection Authority will be able to even enforce the safeguards, the protections, the rights which emerge from the data protection law against a government department. The data localization aspect of the JPC report is incredibly concerning, and it ignores any of the negative impacts which may be there on innovation, for instance, in terms of internet protocols and how it may lead to a form of localization which breaks the open web. The objectives of data localization of the JPC report actually list objectives such as national security, employment generation, and bargaining power, but actually it have no underlying supporting basis or evidence for any of these statements. Clauses 33 and 34 with respect to data localization calls on the central government to prepare and pronounce an extensive policy on data localization. And it also expands the grounds under which transfers of sensitive and critical personal data from India can be restricted. The government will have an ultimate say on what actually gets transferred out of India and which data can also not be mandatorily stored in India and never be transferred outside.
The panel has also recommended that all social media platforms that do not act as intermediaries should be treated as publishers and be held accountable for the content they host. The Joint Parliamentary Committee's recommendations are not binding on the government. The Centre has the option to make changes to the draft bill before tabling it in the Parliament. But in its current state, the bill may undermine the privacy rights of citizens.
Outside the parliament, where Treasury and opposition benches sparred over the Personal Data Protection Bill, green shoots of economic recovery were sprouting across the country. Sitting about 1,500 kilometers away from the seat of power, Chief Executive of Monster India, Sekhar Garisa, told Business Standard's Krishna Veera Vannamalli from Hyderabad that it was a great time to be an employee. The demand for the talents was back to the pre-pandemic level across most industry sectors, and a lot of opportunities were chasing a fewer number of candidates. Let's join the chat.
Welcome to the Business Standard Morning Show, Mr. Sekhar.
Thank you so much.
Just give us an overview of the current job market in terms of job postings at Monster as well as Quest as a large employer.
I think we've been reporting consistently over the past 6 months, ever since the severity of wave 2 has gone down, that job postings have been on a steady uptick. And across most of the sectors, 25 out of 27, we've been reporting that they have been growing consistently, both on a month-on-month basis as well as year-on-year basis. So the job market is as healthy as it could possibly be, despite whatever COVID impact has been there in most of the sectors. There are still a couple of sectors that we would like to see the demand coming back to pre-pandemic levels, travel and tourism, offline education, etc., which have also been picking up over the past 2-3 months. But apart from that, IT hiring has been on a significant uptake for a while now. Retail has been similar. BFSI, thanks to the aggressive plans of a lot of fintech organizations, has seen aggressive hiring. So across the board, I think the situation is very, very healthy.
What are some job trends that you are seeing going into 2023?
BFSI is one, and we're adding rolling fintech into BFSI. That's something that's definitely been witnessing a huge demand in terms of requirement for skilled manpower. Some new sectors like crypto, etc. We just reported this month that a quarter back we barely saw any jobs with relevant skill sets needed for crypto, but this month we've seen more than 5,000 plus jobs available. And sales, while everybody talks about the great war for talent in tech, people often tend to forget that there is this demand for sales professionals is as high across the organizations. While organizations need tech talent, but when you have organizations like fintechs, retail, e-commerce, etc., social commerce go out, you'll also have a huge demand for sales professionals. So we are seeing more organizations being location agnostic now, especially in the technology domain. For the last 2-3 months, we've seen fresher hiring come back with a bang. Fresher hiring has picked up. Almost every single customer that we're talking to have been conveying us the fact that this time the fresher hiring that they are looking at has been the highest ever.
And in your view, what is causing this high attrition among mid-level employees?
I think, see, end of the day, at the core of it is demand supply mismatch. You have to look at it as it being an employee market at this point in time, because there are a great number of opportunities which are chasing fewer number of candidates at this point in time, right? And you might ask, why did suddenly great number of opportunities come? And that's where it's a combination of factors, because almost every organization in their mid-term, near-term plans had a process of digital transformation, digitization. What pandemic has done is greatly accelerated some of those plans. Okay. That's factor number one. Factor number two is, driven by the uncertainty of pandemic, a lot of companies have kind of held on to their plans. And now when we hopefully, when we see the light at the end of the tunnel from a pandemic perspective, all organizations have suddenly now been, emboldened to say, now let me put those expansion plans into action. That's factor number two, which is playing out, right? And factor number three is, while, certain sections of industry have been adversely impacted by pandemic, we also know that there have been many other sectors which received significant investments. So whenever somebody says they've attended a unicorn series by raising $100 million, you have to understand that plan has significant hiring component to it. The challenge of attrition is absolutely real. The war for talent is absolutely real. And organizations have started to believe now that the true differentiator between two organizations is the quality of manpower that they are able to put into work.
Now we come to your other platform, Q Jobs, which you launched for blue and gray collar workers. What explains the traction in this space?
What we always felt is much of this was offline. The hiring activity was always there. And people were struggling to get this process, to digitize this process and build an online platform around it. So there's always been demand around this one. People have been dealing with suboptimal processes for a very long time. But over the past 2-3 years, because people are now more comfortable from a digital adoption perspective, both candidates as well as recruiters and organizations, much of this activity is now moving online. And therefore, when it moves online, everybody feels like there is an opportunity to build a scalable business. The second thing that's happening is there's a bit of formalization that's happening in the blue and gray collar space. Candidates are more comfortable using digital aids. They want to discover what's the best job available to them. They want to find the most appropriate job for themselves, and they're comfortable using a digital platform. Whereas most of this process earlier used to be offline.
From the booming job market, let us turn our focus to the equity market now. Britain hiked the interest rates last week, becoming the first G7 economy to do so since the pandemic struck. The US Federal Reserve and the European Central Bank also signaled plans to rein in stimulus. The different paths taken by major central banks underline deep uncertainties over the fast-spreading Omicron and their differing views on inflation. Yet, one thing is certain, that emerging market equities, including India, that have been accustomed to the easy money policy in the past 18 months, may come under pressure over the next few months. Emerging market liquidity is set to dial back as major central banks of developed economies adjust their policies to tackle the post-COVID era. The Federal Reserve last week announced that it would be aggressive on tapering bond purchases and announced several rate hikes in 2022. The Bank of England, on the other hand, hiked interest rates for the first time since the start of the pandemic, citing a strong labor market and the need to return inflation towards its 2% target. The European Central Bank struck a more dovish tone, further cutting its pandemic-era bond buying program by vowing to stay accommodative through 2022 and beyond. This is in contrast to the Reserve Bank of India, which decided to keep its repo and reverse repo rate unchanged at the December policy meeting, even though it expected inflationary pressure to persist in the near term. analysts feel many emerging markets will be in an increasingly difficult spot going forward as the current inflation shock could prove to be more permanent in developing economies than in United States or Europe. Arvind Chari, Chief Investment Advisor at Quantum Advisors, had this to say. If conditions persist, the US Central Bank may not only hike rates but also begin the process of allowing bonds that it holds to mature and/or sell bonds to reduce the size of its balance sheet. This scenario is not priced in the markets and will be a big scare for risk assets, especially in EMs, which have been a beneficiary of global liquidity. Further, the gradual pullback in liquidity and easy money flow into EM equities will likely slow down their performance in 2022. Let's go to Ambarish Baliga, an independent market analyst, to know more.
The Fed has adopted a hawkish stance with a 3-rate hike next year. Though one may say that this announcement provides some amount of visibility, but the bottom line is that the rates will be raised. BOE has been the first major central bank to raise interest rates. This in turn strengthens the respective currency as fund inflows are expected to take advantage of the increased rates. However, this also means that emerging markets will bear the brunt of the depreciating local currency as the foreign institutional investors will continue to preempt further depreciation and keep selling, especially when the markets are directionless or in a correction mode. So we will see some amount of underperformance from emerging markets, especially in the short to medium term.
Concurring with the view, UR Bhatt, co-founder and director at Alpha Niti Fintech, had this to say.
Unless there are specific factors influencing particular emerging markets which make them stand out, and so therefore they can still attract some flows. But otherwise, generally when interest rates in developed markets go up, generally there is lack of interest in emerging markets.
This shows up in the recent FPI activity in the equity market as well. While the rupee has depreciated by around 1% in December so far, topping the 76 per dollar mark, FPIs have been net sellers of nearly $3 billion in the equity market in the first fortnight of the same month. No wonder then that the BSE Sensex and the Nifty 50 dropped 3% last week, as India remains one of the richly valued emerging markets with a sticky inflation and a weaker currency. For now, the benchmarks stand at 50,012 and 16,985 levels respectively and are expected to trade in a narrow range this week. The 50-pack Nifty, for instance, is expected to trade within a range of 16,250 to 17,450, having support around 16,500 levels. The Sensex, meanwhile, may maintain within a band of 55,700 and 58,100. On the global front, FII flows and news flow around the Omicron variant will be the key drivers for the markets this week. While domestically, initial public offers, new listings of Shriram Properties, MapMyIndia, Metro Brands, MedPlus Health, and data patterns will guide the trajectory. All governments take their share from your earnings, including the one made in the equity market. After several extensions, the deadline for filing the income tax return is finally drawing close. Many of us wait till the last moment to finish this annual exercise, but that is not advisable. You could end up paying a hefty fine or worse, get a notice from the income tax department. In this segment, we try to explain the different categories of ITR forms that taxpayers fill.
For individuals who are not subject to audit, the income tax return filing deadline for the financial year 2020-21 was extended by 3 months from September 30 to December 31. It was first extended from the usual deadline of July 31 because of glitches in the new income tax portal developed by Infosys. Taxpayers also have the option to choose between the old and the new income tax regimes while filing the return. Those who choose the new regime will not be able to claim certain deductions such as the standard deduction, house rent allowance, and those under Section 80C and 80D. It is also important to select the right ITR form based on your sources of income and residential status. For instance, ITR 1 can only be used by a resident individual having an income of up to Rs 50 lakh from salary or pension, income from one house property, and income from other sources. Those with income from capital gains, regardless of the amount, have to file ITR 2. Taxpayers who have income from more than one house property as well as foreign income will also fill this form. ITR 3 and 4 is for taxpayers with income from business or profession, or those who opted for presumptive taxation. To make the task of filing easier and faster for taxpayers, the government this year introduced the Annual Information Statement, which provides comprehensive information to people on their financial transactions. The AIS contains more information than the existing Form 26AS. The taxpayer can import the information contained in the AIS directly to his or her ITR form through the pre-filled facility. Tax filers need to see if the information contained in Form 26AS matches with the information in the Annual Information Statement and in Form 16 issued by employers. Form 26AS includes details about TDS, TCS, advance tax paid, self-assessment tax paid, and financial transactions exceeding certain prescribed threshold limits. This time, the form will also include remittances received from overseas, interest or income tax refund, dividend from mutual funds, purchase of mutual funds, among others. Keep in mind that taking excess credit while filing the return could lead to a notice from the income tax department. Further, if a person files the ITR after December 31, he or she will face a penalty of Rs 5,000. For taxpayers whose total income does not exceed Rs 5 lakh, the maximum late filing fee will be Rs 1,000. If a taxpayer also misses the March 31, 2022 deadline for filing belated ITR, they can file the return only in response to a notice from the income tax department.
Taxes help the government run the country, and their timely payment helps you not only avoid the IT notice and fine, but also improve your credit score. Well, that is all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.